On January 1st, 2025, the government of China executed a strategic move that sent immediate shockwaves through every major financial hub from New York to Tokyo. Beijing officially placed silver under strict state trading export controls. The message to the global community was unambiguous. China, the primary engine of global manufacturing, was locking down its domestic silver supply to protect its own industrial future. Analysts predicted immediate shortages. Industrial manufacturers panicked as they realized the silver tap was being turned off. Predictably, silver prices began a steady and relentless climb. But then, in October 2025, just 9 months into this new era of isolationism, the unthinkable happened. Without any prior warning or policy announcement, China performed a violent U-turn. In that single month, Beijing exported 660 tons of silver. This was not a gradual release of metal. This was the largest single-month export volume in recorded history. More shockingly, the destination for this massive haul was the London Bullion Market Association, the exact Western market that China was supposed to be cutting off. This was not a calculated change in long-term policy. It was not a relaxation of trade tensions. This was an emergency dump. It was a desperate injection of liquidity into a global system that was on the verge of a total physical cardiac arrest. But here is the most terrifying part of the story. Despite flooding the world market with 660 tons of physical silver, the price did not crash. It did not even pause. Instead, the market absorbed all 660 tons and asked for more. By December 2025, silver prices defied gravity and hit $66.21 per ounce. This represented the highest price in human history. What we witnessed in October 2025 was the moment the official narrative of market stability completely disintegrated. Why did China reverse its strategic course so dramatically in less than a year? Why was the world's largest manufacturing superpower forced to raid its own domestic stockpiles to save a Western pricing mechanism? And most importantly, why did a massive supply injection of 21 million ounces fail to stop the price rally? As we move into 2026, the answers to these questions reveal a global financial system that is no longer functioning according to the laws of paper trading. We are entering a period where geology and industrial necessity are overriding the decisions of central banks. The 660-ton dump was a final attempt to stabilize a broken system, and it failed. To understand the gravity of what is coming next, we must look past the headlines and examine the actual physical reality of the silver market. The era of cheap, abundant silver is dead. What remains is a structural deficit so deep that even the world's largest economy cannot fill the void. To understand why the October dump was so significant, we must examine the events of early 2025. When the Ministry of Commerce in Beijing first announced export licenses for silver, they were applying the same restrictive framework used for rare earth metals. This was a clear signal of resource nationalism. China produces over 80% of the world's solar panels, and each of those panels requires approximately 20 grams of silver paste for its electrical contacts. In a world racing toward a green energy transition, silver is no longer just a precious metal for jewelry or investment. It is a strategic industrial grain. Throughout the first half of 2025, the global narrative was centered on Chinese hoarding. Industry experts and commodity strategists expected Beijing to build a massive strategic reserve to insulate its domestic tech giants from rising global costs. For 9 months, the flow of silver out of China slowed to a trickle. The resulting scarcity in the West was palpable. Silver prices moved from $29 in January to over $45 by late summer. The Chinese policy seemed to be working perfectly, forcing Western industries to pay a premium while securing China-owned industrial base. However, behind this facade of strength, a critical breaking point was approaching. The narrative of strategic hoarding was actually a cover for a much more desperate reality. By the time October arrived, the global silver market was not just tight, it was seizing up. The spread between the price of silver in Shanghai and the price in London had widened to an unsustainable level. Earlier in the year, silver in Shanghai was trading at a 15% premium over Western prices. This price gap was so large that it actually incentivized Chinese traders to import silver rather than export it, despite the 13% import tax. Then came the reversal. The 660 tons that poured out in October represented more than double the 5-year monthly average of 310 tons. This was a total abandonment of the January lockdown policy. Why would a nation that prioritized its domestic solar and electric vehicle industries suddenly bleed its reserves? The answer lies in the interconnectedness of global trade. Beijing realized that if the London silver market completely collapsed due to a lack of physical metal, the resulting chaos would destroy the very export markets China relies on for its economic growth. This was a classic case of a supplier of last resort being forced to act against its own long-term interests to prevent a systemic failure. China did not export those 660 tons because they had a surplus. They exported them because the global pricing mechanism was on the verge of disintegrating. It was an act of damage control that signaled to the world that the era of policy control was being replaced by an era of crisis management. The floodgates were opened not out of choice, but out of necessity, marking the beginning of a desperate phase in the global silver war. To comprehend the desperation behind China actions, one must look at the state of the London silver market in late 2025. The London Bullion Market Association, or LBMA, serves as the heart of the world over-the-counter precious metals trade. It is a system built on the assumption of deep liquidity and the constant, frictionless flow of metal. However, by October 2025, that system was experiencing what professional traders call a physical squeeze. This occurs when the demand for actual, physical bars of silver far outstrips the available supply held in registered vaults. The crisis in London was driven by two converging forces. First, industrial demand from Western tech and aerospace firms reached an all-time high. Second, the absence of Chinese exports during the first 9 months of the year had drained the Western free float to dangerous levels. Buyers were no longer interested in paper contracts or digital certificates. They wanted the metal delivered to their factory gates, and they were willing to pay massive premiums to get it. According to senior analysts, the London market was screaming for silver. The premiums offered by Western buyers became so high that the price gap between East and West finally flipped. Behind closed doors, the situation was even more dire. A physical squeeze in London is not just a price issue. It is a systemic threat. If the world's largest silver hub fails to deliver physical metal, the entire global pricing mechanism for silver disintegrates. This would lead to a total loss of confidence in the paper markets, where hundreds of paper ounces are traded for every one physical ounce in existence. Beijing understood that if London seized up, the resulting price explosion would be uncontrollable. It would make silver so expensive that even China-owned state-subsidized solar companies would find it impossible to operate. This is the hidden motivation for the 660-ton dump. China was not acting as a friend to the West. They were acting as a pragmatic protector of their own economic interests. They provided an emergency injection of 21 million ounces to prevent the global pricing mechanism from falling apart. Daniel Galley, a senior commodity strategist at TD Securities, noted that while a wave of imports into China usually drains the West, this reversal saw China acting as the supplier of last resort. They were burning their own internal furniture to keep the global furnace running. However, the intervention failed to achieve its primary goal of stabilizing the price. Even as the 660 tons hit the London vaults, the market barely flinched. The silver was absorbed almost instantly by hungry industrial buyers and institutional investors who recognized that this was a one-time gift from Beijing. The fact that prices continued to climb towards $66 despite this massive supply injection proved that the London squeeze was not a temporary glitch. It was a symptom of a permanent, structural deficit that no amount of emergency dumping could fix. The West had called for help, China had answered, and yet the fire only grew hotter. While the world was focused on the massive flow of silver into London, the real story was unfolding inside the high-security warehouses of the Shanghai Futures Exchange. For years, these vaults were seen as an inexhaustible reservoir of metal, the primary source of strength for the Chinese industrial machine. But by December 2025, the data coming out of Shanghai revealed a terrifying reality. The Chinese silver fortress was not just under pressure, it was effectively empty. The hard numbers tell a story of a brutal and rapid liquidation. On January 12, 2021, the Shanghai Futures Exchange held 3,912 tons of physical silver. This was the all-time high, a symbol of China dominance in the metals market. However, by December 11, 2025, those inventories had collapsed to just 780 tons. This represents a 75% wipeout of visible inventory in less than 5 years. 2,810 tons of silver had simply vanished from the exchange vaults. This collapse in inventory exposes the lie behind the official state narrative. Beijing did not restrict silver exports in early 2025 because they wanted to exert geopolitical pressure. They restricted exports because they were running out of metal. The 660-ton export in October was not a sign of surplus, but a desperate raid on what little remained. To put the 780 tons into perspective, we must look at the rate of consumption. China consumes approximately 19,000 tons of silver annually. This breaks down to roughly 1,583 tons every single month. When you do the math, the conclusion is unavoidable. The 780 tons remaining in the Shanghai vaults represent less than 15 days of supply for the Chinese economy. Specifically, it is 14.8 days of visible inventory. Even if we assume there are hidden, off-exchange stockpiles held by the state, the trend is unmistakable. China has been burning through its reserves at an unsustainable pace to fuel its solar and electronics boom. They are now scraping the bottom of the barrel. This is why the October dump was a turning point. China sacrificed a massive portion of its remaining visible reserves to save the global market, leaving its own domestic industry dangerously exposed. We are no longer talking about a potential shortage in the distant future. We are witnessing a liquidation event in real time. When the Shanghai vaults hit zero, the buffer that has kept the global silver market functioning for decades will be gone. The world is about to find out what happens when the largest consumer of silver on Earth finally runs out of metal to feed its hungry machines. The fundamental reason why China's 660-ton intervention failed to suppress prices is found in the laws of physics. We have entered a new industrial epoch where silver is no longer a luxury, but a core necessity for the survival of modern civilization. Unlike the past, where silver demand was driven by photography or silverware, today it is driven by the three pillars of the 21st century economy: renewable energy, electric mobility, and artificial intelligence. In the solar sector, silver is the critical component that allows a photovoltaic cell to convert sunlight into electricity. China produces over 80% of these panels. Each unit requires silver paste to conduct energy with maximum efficiency. While engineers have tried for decades to substitute silver with copper or aluminum, they have failed. Copper oxidizes too quickly, reducing the lifespan and efficiency of the panel by 20 to 30%. In a world where every percentage point of efficiency translates into billions of dollars, physics does not negotiate. Silver has the highest electrical and thermal conductivity of any element on the periodic table. Period. Furthermore, the rise of electric vehicles and AI infrastructure has added fuel to the fire. An average electric vehicle uses nearly double the amount of silver found in a traditional internal combustion engine due to the complex power management systems and battery connections. Meanwhile, the massive build-out of data centers to support AI requires high-performance electrical contacts that only silver can provide. According to industry data, global industrial demand hit record highs in 2024 and 2025, with solar production alone increasing by 20% in a single year. The mathematical reality is staggering. In 2024, China produced approximately 3,300 tons of silver, but it consumed 19,000 tons. This created a staggering annual deficit of 15,700 tons within China alone. This gap was historically filled by recycling and importing metal from the West. But as the West faces its own shortages, the bridge is collapsing. The 660 tons sent to London was a drop in the ocean compared to a global deficit of over 215 million ounces recorded by the Silver Institute. We are witnessing a structural mismatch that cannot be solved by higher interest rates or government decrees. When a technology requires a specific element to function, and that element is no longer available in the required quantities, the price must rise to a level where only the most critical users can afford it. This is known as demand destruction, but for the solar and AI industries, silver is a non-negotiable cost. The world hunger for silver is now unstoppable, and the emergency stockpiles that once acted as a safety net have been devoured by the very machines they were meant to power. While the world's eyes were fixed on the friction between Beijing and London, a third player was quietly absorbing the world's remaining silver supply at a rate that shocked commodity analysts. That player is India. In September and October of 2025, as China was preparing its emergency dump, India was engaged in an unprecedented buying spree. According to trade data, India imported over 2,600 tons of silver in just those 2 months. To put that in perspective, that is nearly 4 times what China exported to London in the same period. The Indian demand is a unique and powerful force because it combines two massive drivers: aggressive industrialization and a deep-rooted cultural tradition of physical wealth. As part of their massive renewable energy transition, India is installing solar capacity at a record pace, rivaling the growth rates seen in China. Their economy, growing at 8 to 10% annually, requires massive amounts of silver for electronics and infrastructure. But unlike Western consumers who are content with digital assets, Indian citizens and businesses prefer to hold physical metal as a hedge against a depreciating rupee. Image showing the flow of silver from China to London and then to India. The most revealing part of this story is where India's silver actually originated. Analysts tracking the global flow of metal discovered a fascinating trail. A significant portion of the silver arriving in India was routed through Hong Kong and Switzerland. Specifically, 1,000 tons came from the United Kingdom, and 880 tons came from Hong Kong. Industry insiders suspect that a large chunk of the 660 tons China dumped into London was immediately leased or sold and re-exported to India. This reveals the true fragility of the global supply chain. China was bleeding its stockpiles to save London, but London was merely a transit point. The metal was being sucked into the Indian vacuum almost as soon as it arrived. This created a situation where the London Bullion Market Association was acting like a sieve, unable to retain the very liquidity China was trying to provide. The physical scarcity was so acute that Indian silver futures hit record premiums, reflecting a desperate domestic need for metal. This India factor ensures that any future attempt by China to stabilize the market will likely fail. As long as the second and third largest economies on Earth are competing for the same shrinking pool of physical silver, the price has nowhere to go but up. India is no longer just a jewelry market. It is a strategic industrial vacuum that is accelerating the exhaustion of global silver reserves. When you combine China's internal deficit with India's external hunger, you realize that the 660-ton dump was never going to be enough. The global silver market is being emptied from both ends. To understand the gravity of the 2025 silver crisis, we must look back to the most famous event in the history of this metal, the Hunt brothers' squeeze of 1979 and 1980. During that period, brothers Nelson Bunker Hunt and William Herbert Hunt attempted to corner the market, accumulating an estimated 100 million ounces of silver. Their aggressive buying drove the price from roughly $6 in early 1979 to an all-time inflation-adjusted peak of nearly $50 in January 1980. At first glance, the price action of 2025 looks similar. Silver rose from $29.50 in January to over $66 in December, a gain of over 120%. However, there is a fundamental and terrifying difference between these two eras. The 1980 peak was a speculative bubble driven by two wealthy individuals using massive financial leverage. It was an artificial squeeze that collapsed once the exchange rules were changed and the brothers were forced to liquidate. The crisis we are witnessing today is not driven by speculators or the Hunt brothers. It is driven by geology and the physical exhaustion of the earth. In 1980, there was plenty of silver in the ground and in vaults. It was simply being hoarded. In 2026, the silver is actually gone. According to the United States Geological Survey, global mine production has been stagnant or declining for years. In 2024, mine supply dropped to 823 million ounces, even as industrial demand hit record highs. This is a structural deficit, not a financial manipulation. When the Hunt brothers cornered the market, they were fighting against the banking system. Today, the banking system and major industrial nations like China are fighting against the limits of the planet. China's 660-ton dump was an attempt to replicate the stabilization of the past. But you cannot stabilize a market with paper when the world needs physical atoms for solar panels and AI chips. History shows that when silver enters a true supply squeeze, the gains are not linear. They are explosive. In the 1979 cycle, silver gained over 700% in just 12 months. If we apply that same historical magnitude to our current situation, where the scarcity is real and structural rather than speculative, the price targets being discussed by analysts start to look conservative. We are not just reliving 1980. We are entering a period where silver is reclaiming its role as a strategic asset of the highest order. The difference this time is that no change in exchange rules can manufacture more silver out of thin air. In the year 2025, a quiet but monumental shift occurred in the halls of power in Washington, D.C. The United States Geological Survey officially added silver to the critical minerals list. To the average observer, this might have seemed like a mere bureaucratic update. However, in the world of global finance and geopolitical strategy, this was a declaration of war. By designating silver as a critical mineral, the United States government signaled that silver is now a matter of national security, placing it in the same category as lithium, cobalt, and rare earth elements. This designation changes the rules of the game. It grants the American government the authority to implement tariffs, provide state subsidies for domestic mining, and, most importantly, restrict the flow of silver under the framework of national defense. As trade tensions between the United States and China continue to escalate in early 2026, silver has moved from the commodity pits to the center of the geopolitical chessboard. We are no longer just looking at a market deficit. We are looking at the weaponization of an element. China, having observed the Western response to their rare earth dominance in 2010, understands exactly how this game is played. For decades, Beijing used its control over 97% of rare earth production to force Western tech companies to move their manufacturing to Chinese soil. Now, with silver, they are attempting a more complex maneuver. The 660-ton dump in October was a temporary truce, a way to keep the global system functioning while they rearrange their internal defenses. If the United States and China enter a full-scale trade war in 2026, silver will be at the very heart of the conflict. Beijing could easily decide to stop all silver exports again, not just to hoard the metal, but to cripple Western high-tech industries. Without Chinese silver, the American solar transition grinds to a halt. The production of advanced medical devices stops. The construction of AI data centers, which are the backbone of future economic dominance, becomes impossibly expensive. We are entering an era of resource tit for tat. The United States may use its dominance in semiconductor technology to squeeze China, and China will respond by squeezing the silver supply. Caught in the middle are the industrial manufacturers and investors who realize that silver is the Achilles heel of the modern world. The price of silver will no longer be determined by a simple balance of supply and demand in London or New York. It will be determined by the strategic needs of superpowers. In this new reality, a $66 silver price is just the beginning. When silver becomes a weapon, its value is no longer measured in currency, but in power. As we enter the first quarter of 2026, we are moving past the realm of speculation and into the territory of cold, hard arithmetic. The global silver market is no longer a functioning system of price discovery. It has become a countdown. Based on the current trajectory of Chinese inventory depletion and the persistent global mining deficit, the next 12 months will likely witness the most significant price dislocation in the history of precious metals. The timeline for this crisis is already being written by the data. In January 2026, we expect the Shanghai Futures Exchange inventory to fall below 500 tons. This is the psychological breaking point. Historically, when visible inventories drop to this level relative to total consumption, the market enters a state of permanent backwardation, where the price for immediate physical delivery is significantly higher than the price for future delivery. This is the signal that the paper markets have lost control. By February 2026, we anticipate that Beijing will have no choice but to re-implement strict export licenses. The emergency dump of October 2025 cannot be repeated. The furniture has been burned, and the house is still cold. If China cuts off the flow once more to protect its remaining 14 days of supply, the London market will find itself in a vacuum. Without the Chinese buffer, the physical premiums in Western markets could explode to 20 or 30% above the spot price. The most critical moment will arrive in the second quarter of 2026. This is what analysts call the decoupling. In this scenario, the major futures exchanges like the COMEX and the LBMA may be forced to settle contracts in cash rather than physical metal because there is simply no silver left to deliver. When a commodity exchange can no longer provide the commodity, the paper price becomes irrelevant. The true price will be discovered in the physical market, where industrial giants will bid against one another in a desperate war for survival. Technical analysts looking at the gold to silver ratio provide a glimpse into the potential price targets. If gold remains near its 2025 levels of $2,300 and the ratio reverts to its historical crisis average of 40-1, silver should be trading at $57.50. But in a true physical squeeze, the ratio has historically compressed even further. At a ratio of 25-1, which we saw during previous periods of extreme scarcity, silver would hit $92 per ounce. Some institutional researchers are already modeling scenarios of $200 to $300 per ounce if the supply chain completely fractures. These numbers are not fantasies. They are the mathematical result of a world trying to buy an infinite amount of technology with a finite amount of silver. The events of 2025 have provided us with a clear and chilling map of the future. China's decision to dump 660 tons of silver into the global market was not a sign of strength or abundance. It was a final, desperate attempt to stabilize a dying system. It was the act of a captain throwing cargo overboard to keep a sinking ship afloat for just a few more miles. But as we have seen, the ship is still taking on water, and the cargo is nearly gone. We must accept the reality that the silver market has shifted from a cycle of fluctuations to a state of structural failure. The old rules of investing no longer apply. For decades, investors were told that silver was a volatile metal, a speculative play that followed gold. Today, that narrative is obsolete. Silver is now a strategic industrial necessity that is being exhausted by the very technologies we rely on for our future. From the solar panels on our roofs to the AI processors in our data centers, the modern world is built on a foundation of silver that is rapidly eroding. The collapse of the Shanghai stockpiles to 780 tons is the ultimate indicator. It is the canary in the coal mine. When the world's manufacturing superpower runs out of its most critical industrial grain, the global economy enters uncharted territory. The 660-ton dump failed to stop the price rally because you cannot fight a physical deficit with financial maneuvers. You cannot print more silver. You cannot legislate more geology. And as India continues to vacuum up the remaining global supply, the pressure on the system will only become more intense. As we move deeper into 2026, the window of opportunity for preparation is closing. The institutional players and central banks have already begun their positioning. They understand that we are moving toward a world of three-digit silver prices, not because of a bubble, but because of a fundamental lack of atoms. The decoupling of the paper markets from physical reality is not just a possibility, it is a mathematical certainty. When the vaults finally hit zero, the price will no longer be a number on a screen. It will be whatever the last person holding a physical bar of silver demands. This is the end of the era of abundance and the beginning of the era of scarcity. The October shockwave was just the first tremor. The true earthquake is yet to come. Whether you are an investor, a manufacturer, or a student of economic history, the message is the same. The math does not negotiate, and the clock is ticking. The 660 tons are gone, the vaults are empty, and the world is about to discover the true value of the most indispensable metal on Earth.